Fools. I'm John Rotanti, and this is My Investing Life, where I interview the investors I admire most to learn about their investment process and philosophy. Today, I'm speaking with Sean Emory of Avory Company. Sean is the founder and chief investment officer at Avory. He's also one of the best investors to follow on Twitter, period. And you should check out his blog, which you can sign up for at avory.xyz. Make sure you sign up for his earnings quick takes that he sends out via email. They are incredible. So let's learn about Sean's investment process and philosophy and some of his favorite stocks. Sean, welcome to the show.
How you doing, John?
I'm doing really, really well. We're thrilled to have you. So Sean, tell us about Avory.
Yeah, I guess that's a good place to start. So Avory is born in Miami, Florida. I was also born in Miami, Florida, so that makes sense. We're about 5 years old. We run $350 million of assets. Our strategy, our business was built around kind of independent research and putting those into our strategy. We run high conviction strategies. So anything from an equity to kind of a multi-asset portfolio, but our bread and butter is our high conviction equity portfolio. We have kind of this context of private equity-like investment or mindset in the public markets. So that's kind of a nutshell of us. There's 5 of us here in Miami. We're kind of a high octane team in terms of doing a lot for a very select few of our investor base. And that's really it. That's kind of the high level view of Avory.
I love it. And I was just telling you offline a second ago how much I love Miami as well. So what is your investment philosophy and what types of businesses do you like to buy stock in?
Sure. Yeah, I think stepping back and thinking about where we land on the investment curve, we think we have this research mission, which is called Discovering Value in a World of Innovative Growth. And when I say that, I mean, the world is kind of bifurcated between value and growth. And what we try to do is really step back and look at each company individually and ask ourselves kind of, is there value left in this investment? And ultimately what that means is whether a company is growing at 80%, or a company that is not growing at all and actually maybe potentially declining, is there value left in that investment? And that leads us to 2 pillars. One is structural growth stories. And then the other side of that coin is transformation stories. And just to kind of decompose that a little bit, structural growth stories are really what we call innovation blocks. So we sit back and we ask ourselves questions around the world, where it's headed, kind of why am I sitting on a street corner and I'm calling 7777 and I'm waiting for someone to pick me up in a yellow taxi. I've never met the person. I don't know their rankings or anything like that. And all of a sudden, fast forward 15 years after that idea, we're here kind of obviously calling Ubers and things like that. Now, those were questions left to be answered. And there was this evolution of technology that led to that. So structural growth stories today, when we think about them, are things like the shift to a cashless society, healthcare automation, and kind of the list goes on. We have about 10 that we're tracking today. On the other side is transformation stories. And again, that's more around companies that are looking to unlock value through some form of transformation. And one good example of that was successful for us was Chipotle like 4 or 5 years ago, where there was a successful transformation at the C-suite, where we went from founder-led to not founder-led, and someone that had executed at a high scale at Taco Bell. So that was Brian Niccol. And that was a transformation where they shored up the supply chain, shored up some of the problems, and then expanded the menu and the platform itself. So we think those are 2 kind of areas that we want to spend most of our time in from a high level. So structural growth stories, transformation stories, I think that really best defines where we put our investment effort.
I love that. I like how you bifurcate the portfolio. I also love the sort of overarching philosophy of looking for value in an innovative growth world. So yeah, love that. So you just talked about your investing philosophy. Can you tell us a little bit about your portfolio management philosophy and strategy? How many stocks do you typically own in a strategy? What's typical position sizing? Do you hold cash? Those types of things.
Yeah, no, these are good questions. We get this a lot. So in general, from a portfolio management perspective, so we run a strategy called Premier Growth. And this is 8 to 25 holdings. We tend to live somewhere in between that. And in a world of kind of thousands of securities, it allows us to kind of be very, very picky in terms of what we own. The sizing of our positions, again, we try to take this equal weight mindset where we're trying to build to equal weight. And sometimes that means securities run into equal weight. So just as a sign of example, 10 holdings in a sense would be 10% each. Generally speaking, we're running around kind of 7 to 12% positions at what we would call like their mature state. And we would scale that down from, let's say 15, 16, 17 down back to 12 as it hits that kind of upper bound. In addition, as we kind of build our positions, we start at either a half or we use put options a lot in our portfolio where we sell put options to build our positions. And that allows us to obviously lower the cost base originally to a level that is anywhere from 5, 10, 15% below that current price. So again, in a period where potentially volatility is high, put option selling makes a lot of sense. Outside of that, when kind of there's a lot of complacency, it's not as attractive. But again, at a high level, we're trying to run this strategy at equal weight. And really the rationale behind that is trying to remove kind of our internal bias of, while we may have valuation as kind of the guiding principle, and many do in terms of providing weights, the real question there is looking internally and asking yourselves, is there bias in your valuation? And is there bias in your growth metrics in terms of your what you're putting on someone like a PayPal versus someone that is going through a transformation? So to remove all that, we try to take this equal weight mindset and remove the biases in terms of portfolio construction.
I love that. How do you think about risk management in a concentrated portfolio?
Yeah, I mean, one of the biggest kind of from the outside looking in is a lot of people look at tracking error in terms of like how much you track relative to markets. And the beauty of our strategy is we don't track relative to markets. And that makes me feel better internally, specifically in some years. But in general, it allows us to step away from the markets and really think about the underlying holdings themselves. I don't think we've had one year where we've been within 10% of the market, for good or for worse. And ultimately what our investors are doing is investing in us and actually a subset of the market and in these companies. The way we think about kind of risk is really at the company level. Is this management team, the business, the product, the margins, are all those sustainable? So we do take kind of anecdote of, let's say, Warren Buffett and kind of Ben Graham in terms of the economic moat concept, where we are looking for companies that are trying to build a moat, either have kind of a dominant moat today, or ones that are, again, building a moat through time. Generally speaking, our best investments have come through the evolution of the moat, where the moat doesn't exist in kind of a way that we all think of moats, where it's small but kind of blossoming like a flower. And ultimately, that's what we're looking for. A good example of that was Square's Cash App, right? Cash App itself, early days, had 2 million users. But once you get to 40 million users, now you have real network effects that are taking place, specifically when it's primarily a domestic product. Before that, 2 million, there was the ambition of a moat, but it wasn't there yet. But then you had the core seller business that was, again, something that investors and the company could lean on as kind of this product portfolio that they could essentially strip cash flow on and reinvest back in a Cash App. But anyways, again, from a risk management standpoint, we use economic moats as kind of that form of safety.
Yeah, and like you said, if you can find them sort of pre-moaty, like an emerging moat, sometimes there's some big gains to be had there. How large is your watch list or your on deck list? In other words, does Avory & Company have a list of companies that it has done thorough research on and that you like, but you just have not yet bought the stock because you haven't seen that value yet? Do you have that list? And if so, how large is that list?
Yeah, I mean, we have a long list for sure. Mm-hmm. And I think the list really is formulated due to kind of our process. And we haven't necessarily discussed like the details in terms of the process, but we have a process that we have discovery, follow, focus, and then approved or not approved, right? So discovery is really companies that enter our aperture, and we're looking for companies that either are in those structural growth categories and or transformation stories. And we don't know really anything about the company. Potentially we know the product. Maybe we've used it ourselves as consumers. Maybe we passed a billboard and we saw something. Maybe they went IPO and we watched the roadshow, things like that. That's how we enter the discovery phase. From there, we go to the follow phase. And the follow phase is now we're really trying to understand all the details around this company. We're following product announcements. We're following all the kind of more tangible things to a business outside of the markets, and really trying to grasp and understand management and product. I mean, ultimately, that's what we're trying to do there. So those two lists are fairly long, right? These are what we would consider watch lists. Now, the focus phase is really where we take it to the next level, where we are trying to understand whether there is a moat developing or it's been developed. There's sustainability to this company. Here's a management team that we do believe can execute over time. And from there, we take it through our focus phase, which is a pretty large and intensive process of trying to understand essentially everything that we possibly can of the company and either approve it or not approve it. Most non-approvals are valuation based, and that is probably, I would say, 90% of the story. And in some cases, we're going through our focus phase, and all of a sudden, the company is no longer as attractive as it once seemed. And maybe that's management. And as we've gone through the process of understanding the project's evolution, we step back and we say, you know what, execution here for the last decade has actually been pretty subpar. Some of its competitors have moved at a quicker pace, and you start to realize that over time throughout the analysis. And that puts it in kind of this disapproval list that you try to articulate what the problem was, and potentially later on they solve it, right? And that's kind of the list. So when you kind of bunch all those together, you have anywhere from like 85 companies that are sitting kind of in one of these verticals of discovery, follow, and focus. And then there's a bunch of approved companies, and that comes in handy during times of like March of 2020. Yep. I think we bought like 5 companies in March of 2020. And again, we're not trying to like time anything per se, but generally speaking, we had a large approved list, and very rarely do you get those type of moves. And again, we thought it was going to take years and multi-year to kind of recoup any of those. But obviously we all know what happened. Yep. But beside that point is having that approved list, I think, is pretty important to have, where valuation is the only concern.
I mean, I love for a 5-year-old firm, you already have so many frameworks in place and processes in place. And they seem so well thought out. I'm really, really fascinated by your research process. So I want to dive in just a bit more. Do you have assigned companies that you follow, or do you all kind of follow them equally? Are you generalists? Are you specialists? And how do you work as a team? Do you meet regularly to have stock pitches? Like, what does it look like as a team?
Yeah, that's a good question. So generally speaking, how we think about our coverage is generalist. The guiding principles are those two verticals or pillars. So structural growth being one of them, and underneath that are 10 innovation blocks. So that's really the guiding principles. Now, do we provide kind of who's going to cover what? So for example, I have a pretty good understanding of fintech and shift to a cashless society. Chris Fuentes has maybe much more understanding of another category, so we'll split there. But generally speaking, we are covering everything together. And anything that goes in the portfolio, we all have to understand. We meet every Friday from a communication standpoint of what new IPOs came to market, any kind of findings there, any new details around companies we are following and or competitors that we're following. And then any new additions to the discovery, follow, focus. And that's ultimately the rate that we move at. We believe in continuous kind of analysis. And so we do have Slack, and we're continuously providing data and research daily on kind of key findings that we see from either it's a product announcement of a company we're following or investing in. And ultimately, we believe in that continuous approach. So we're always communicating, and we take that generalist approach where we all understand everything together. And the beauty and the reason we can do this is when you invest in 8 to 25 companies, that's why we can do it. If we had a portfolio of 100 securities, we'd have to completely dice this thing up into huge pizza slices for sure.
Do you incorporate the macro environment into your research process at all?
Yeah, I mean, yes and no. So we obviously are very much macro aware, and macro will have implications on things. So obviously, if we are looking at something like a Zillow, the housing market is pretty important to the direction of Zillow. Now, if we step back and think about our core idea and principles, is we truly are long-term investors. And what that ultimately means is we believe investing through these cycles, through these kind of macro cycles, and not everything's going to work at all times. And if you try to just simply time, and again, there's some investors that try to do that, and that's fine. For us, it's we understand the reason why Apple and Netflix and many of these other kind of very successful investments that have happened for decades. These were decade-long investments that moved and pushed through multiple cycles of all types. All types of crises occurred, right? Everything from Russia and Argentina and Japan in the early 90s, all the way to the last like 10, 15 years, where a housing crisis and so on. I mean, a good example, look at Blackstone. It's been one of the better investments for a long time now. And they probably peaked. Probably one of the worst purchases ever was Hilton, but it also then became one of their best investments, arguably in the history of real estate. And they bought that in 2006, 2007. So for us, macro is really, really important, but our goal is to find something that's structural in nature and long-term in nature, and try to invest through those cycles. Again, it could be tough at some moments where macro is going against you, and I get it. But the reality is we're trying to find good companies for the long term.
How do you analyze corporate management? In other words, what are you looking for in a CEO and their team?
Yeah, I mean, that's obviously super important. I know there's this generalized concept in the world around founder-led companies. And generally speaking, we do touch and invest in a lot of founder-led companies. And I think it's more about the rationale than them being founders. And really the question there is, when we look for a management team, we're looking for execution. That's part of the thought process there. And it's a checklist for sure. But execution to a point, right? So, I mean, I'm going to go back to the well for one of the companies, Chipotle. You have to assume, obviously, over multiple decades, that the founders there were very strong. They executed incredibly well. But potentially it comes to a point where the world's changing. They potentially are stubborn in kind of the world's changing, and they're too stubborn to change with it. Or there's an issue out there that they simply don't have the experience because they've just been one way. I mean, going from 200 locations to 2,000 locations is a pretty big difference, specifically when you're trying to source locally. That sounds like a pretty big kind of experience gap that you have to build through time. And potentially bringing somebody in from the outside makes some sense. So we're looking for execution, historical execution, and kind of recent execution. You know, there's something about the way sometimes a CEO speaks about their business. And again, it could be a CEO, non-founder, and it's really around their demeanor and how they communicate things. We think the faster, we've seen a lot of times, Carvana is like a pretty good example, where Ernie Garcia speaks incredibly fast about his business. And our biggest takeaway there is that he completely understands his business in and out. And he's able to articulate it in a pretty quick way. And again, that may not be widespread in terms of using that as a gauge, but it's those little habits that we think or predictors that we think are pretty valuable and are more of a positive than a negative. I think that's the best way to define that. Now, there's other things like alignment, whether it's incentives, whether it's where they've come from in terms of their true passions. So when we're thinking about a management team, it's really around historical execution. It's their demeanor and understanding of the business. It's their ability to hire. I think Jack Dorsey does a really good job at hiring over the last decade. I mean, he's more of a visionary. Everyone underneath them is the army. And they've done a wonderful job. Clearly, if you just looked into the history books of things that happened at PayPal and kind of how all of that shot out into the world, and so many companies blossomed because of ex-PayPal employees. Trying to understand kind of some of the behavior traits that happen there. I think those are good things that we take away and try to use in terms of management analysis, legal stuff. So we run background checks and stuff like that, but those are more standard in nature for us. So anyways, that's kind of it. We're looking for someone that knows how to execute at scale and is also a visionary and or has the wherewithal to separate that between who's the execution individual at this company and who's the visionary.
How do you think about valuation? Are you building models and discounting cash flows? Or are you thinking about valuation using other methods and tools?
Yeah, no, valuation is pretty important. So we take a pretty strict approach to valuation. We basically try to take an approach where we try to size the market, obviously, and from there we move into kind of market share. So whether it's Planet Fitness or someone else, where we're again trying to understand how big is this market tangibly, like realistic sizing, trying to carve out kind of what kind of share can they take. That will give us a pretty good revenue area. Then we're trying to understand what their steady state margin profile can look like. And generally speaking, what you see throughout history is that margins tend to repeat themselves across various industries. They level out at some sort of competitive level. And depending whether it's software, hardware, or product-based, or cyclical or non-cyclical, or commodity versus not, you can find some pretty strong parallels. From there, we try to understand, or we apply a multiple, and our multiples are anywhere from 10 to 15 times. And that's what we call a mature or steady state of this business. So this is the size of the business, revenue and margins, where growth is essentially non-existent anymore. So I think Oracle's and IBM's and Microsoft like 15 or 10 years ago, and Apple even like 7 years ago. And then the list goes on in terms of big banks and some of the others, where that 10 to 15 multiple is where these things tend to hover. It's also the reciprocal of that is 10 is 10, right? So 10% earnings yield. So that's essentially your earnings that you would be generating, or income, or however they pay it out at maturity. So that's how we think about valuation. So we're whatever that multiple times that mature margin, revenue, and operating income, that's ultimately what we think the valuation of that company is. And then we ask ourselves kind of, is this a return that is acceptable within our portfolios?
Awesome. Last question before we start talking about stocks. What would cause you to trim a position versus selling out of a position altogether?
Yeah, the number one thing for us, so when you're only investing in a couple companies, you're pretty strict in terms of the entry. So the exit is also, by that nature, very strict as well. It all comes down to visibility. So we want to have visibility in any of our companies, meaning whatever the driver of the business is, we have decent visibility about that driver. And that could be, I mean, look, COVID was like the ultimate visibility fog cloud that you could happen, right? Where companies literally shut down their business in some cases. And we had a couple where literally their whole operations are essentially shut down for a month. And ultimately what that means is there's no visibility. And then assuming you have any sort of debt at all in the future, or any other liability that's coming up, that lack of visibility, I think, is that main driver of any sort of sale at all. From a kind of trim or non-trim, for us, we have like what we call a heck yes, heck no approach. So it's either in or it's out, essentially. And ultimately, where valuation and also visibility come into hand, that's kind of how we're judging whether like we have this heck yes or heck no within this company. So again, when visibility is non-existent, for us, that is not a heck yes, so therefore it's a no in our portfolios. And then typically in those, if visibility clears, then generally we are right back in. And again, whether it's lost value, hasn't lost value, it doesn't necessarily matter, because for us, again, is the biggest risk in a portfolio is material loss of value, where again, you have a debt coming due in a year and you can't pay that debt. that's where you essentially have a permanent loss of value. So that's ultimately what we're trying to avoid.
Heck yes or heck no decisions. That makes it pretty easy and straightforward. So let's talk about some stocks in your portfolio. What is your investment thesis in Alphabet, the parent company of Google?
Yeah, so from it, when you step back and you look at like Alphabet and some of the others that are very similar in nature in terms of the market they're targeting, I think it's really around eyeballs. It's really around the entryway into all the questions we all have. And I think from a standpoint of Alphabet is the size of that digital ads market. So that's their core competency today. That's not necessarily our core thesis. We think they have a stranglehold on digital ads, obviously because of my first point, which is they are the place we all go to get answers. That market itself is roughly like $400 billion today to grow another 200 billion globally over the next several years to roughly 600 billion. With more eyeballs and more space in terms of questions in the world and indexing all that, which means more ad space, which means more potential market share there. But beyond just the core ads business, which again, we think has a dominant moat around that business, is really everything else, which is productivity. We think COVID accelerated their focus on productivity. Before, I think Gmail and some of the other products in their portfolio of productivity was kind of broken, and we could all kind of feel that there was really no effort being done to kind of put this all together. They finally have started to try to think about how do they make a holistic kind of centralized place for people to not only ask their questions, but to start their day in their work life. And that's obviously workspace. Now, beyond that, you have Google Cloud. And again, I think what we've seen over the last probably several years is while Amazon AWS is first to market and in many ways the bellwether, what you're seeing is a strategy around multi-cloud. So more vendors are seeking multi kind of, whether it's either purely for backup and or to not have vendor lock-in. They're looking to be in Azure, they're looking to be in Google Cloud, and they're looking to be in Amazon. There's also, as Amazon continues to encroach into new markets, there's this natural hesitation to wanting to work with AWS to begin with. Now, in addition to kind of like just cloud is their analytics capabilities. So we all know Google has some of the best kind of machine learning and artificial intelligence and kind of indexing. I think the best way to frame this is go onto Gmail, go onto Outlook, type in search for something for the same thing, and I bet Google, you'll find it much faster. And it makes sense. They run a search engine for the whole world. And so their index capabilities. So if the future is around analytics, data, I think you have to think about Google's cloud division. And then Waymo is the last part of this equation where I think autonomous vehicles and transportation, obviously transportation is a massive market. Autonomy is very horizontal in nature. So it doesn't necessarily have to just cover a specific form of transportation, but it's more the capabilities of understanding where something is going and what to do. But my point around this concept is Google or Alphabet is currently viewed as the ads business, but I think you have to think across the other aperture of everything else they do. On top of that, the cash position they have and the strength of the balance sheet, and then the valuation from our standpoint is very attractive from given all the potential opportunities that they have. So I know there's a lot there, but trying to wrap that all together into one, I think is a really strong opportunity for this kind of combination of moat plus valuation is pretty interesting.
That was wonderful, and I agree. So similar business, at least for the advertising business. What is your investment thesis in Facebook?
Yeah, very similar. And they're both facing the same kind of like headwinds, which is I think what's creating the opportunity or has created the opportunity. There it's again, we know the ads businesses will continue to be strong. Yep. And that's kind of like, that's what they'll lean on. Alphabet and Facebook will lean on that. And that's the good thing. Now, beyond that, and they kind of work in tandem for Facebook, is commerce and payments. So I think when you step back and you think about the journey of the future of commerce, I think where's the front doors happening? Where's the online digital department, not department stores, but malls? Where's our attention gravitated? I mean, historically, the mall was a place where families and kids would spend and entertain themselves, and then spend money sometimes, right? And what you're seeing in our belief is that Instagram will become the online mall, where a lot of our time and attention is sitting on this platform. Visuals are beautiful. I mean, when you walk through a mall, I mean, their whole goal is obviously to capture your attention as well. So there's synergies between kind of that concept between a physical mall and a digital mall. And I think Instagram does a really good job at kind of blending social and commerce potential. Now, the beauty of Instagram and even Facebook, the core platform, is that they don't have to get it right the first time. They can continue to iterate until they kind of crack that code in terms of truly having commerce take place on the platform. And I think businesses, in addition to the consumers, like it. I mean, I personally like having a feed where Nike is putting cool ads on my feed, and I think those shoes are cool. And that experience for me is much better than random ads on my platform. And again, when you think of Facebook, I think the opportunity is around commerce and then payments. We'll see how quickly the adoption happens there, or if at all. But if they can combine payments or like top of funnel engagement with commerce capabilities plus payments, I think that's powerful. Combine that with Oculus and WhatsApp Business, their app downloads are on fire. And it's kind of like parabolic. It's pretty shocking to see just how fast the WhatsApp Business adoption has been recently. And then again, Oculus. I think Oculus is the leader in the space, and Facebook is quietly acquiring a ton of publishers and studios that are creating things in VR. So there's the metaverse concept. We can go there, but in it, like for the most part, it's really just around what are they doing today and kind of the foreseeable future. Beyond that, I think again they're well positioned for that. Everyone has a avatar, right? Their own little avatar, and they have 3 billion users, so they're well positioned to create a community outside of kind of the 2D communities that we live in today. So that's really around Facebook.
Both of these theses, you have two companies. They have this core business, like you said, that's just wide moat, durable.
Yeah.
They use those cash flows and they redirect them into all of these other lines of business. And so you have these two companies, Alphabet and Facebook, based on what you've just told me, that have multiple levers they can pull, multiple avenues of growth, multiple lines of business, plus those huge balance sheets and those wide moats. And then you said the valuations are compelling as well. So how do you incorporate regulatory risk into your analysis with Google and Facebook?
Yeah, I mean, that's like the big question is around regulatory. And I guess the way we think about it is kind of what are the potential outcomes, and like depending on the outcome, what is the eventual outcome of that, right? In terms of financial. And when you really start to decompose that, I think the best way to frame it is if you break them up, now you unlock potentially each individual company's ability to perform on their own. Think eBay, PayPal. Like I think both of them are doing better without each other. And then there's historical examples of that as well, where again, what is Instagram worth all by itself? What is Oculus now worth all by itself? If we're truly talking about VR, AR, and Oculus, and metaverse type concepts, and gaming, and many other these capabilities. Same with Google. And again, you would have to try to understand which part of these companies would go together, right? Does YouTube and Google search go together, or does YouTube and cloud go together, or something like that, or are they all broken up? But either way, I think many of these companies, because of the conglomerate kind of discount, you don't really, they're not being rewarded if you did like a sum of the parts for all of these businesses. I think a breakup actually unlocks material value across all of these, and also unlocks potential creativity. That wasn't, it's kind of there, but again, we've seen historically where it's more of a a copy than the innovator. And whether that brings like kind of that innovator mentality to something like Instagram or WhatsApp. Now, in addition to that, the flip side of that is that they kind of clamp down and put pressure on kind of these platform companies, where I think that would ultimately further entrench their moat status in terms of the difficulty of someone coming up and kind of creating something that can compete directly with them, because we've seen it in the banking system, and it's taken decades to have somebody kind of come underneath and try to create fintech type of economies outside of the big banks. So again, when you think of the regulatory risk for the Alphabets of the world, the Facebooks of the world, I think the best way to think about it is the outcomes. And I think either way, the outcomes actually favor the incumbent in many ways, or the sum of the parts in terms of valuation. So that's ultimately how we think about it. Fines, I mean, look, their balance sheets are war chests. So we've seen fines historically. And then lastly is precedent. We've seen Microsoft like 2 decades ago, and the outcome of that was many years of kind of litigation and like just communications in terms of potential breakups or not, or monopoly or not monopoly. And ultimately throughout that time, Microsoft as a precedent was up over 1,000% during that time. So anyways, my point for all this is we think regulatory risk is a risk, but also overblown in terms of the context of an investment. So.
Yeah, you either get the regulatory capture and that cements their competitive position, or you get a sum of the parts breakup maybe, and that unleashes value. So video games are one of the industries I talk about a lot on Motley Fool Live, because I have this idea, been talking about it for about 1.5 years now, that video games and other virtual worlds are going to become the new third place where people go to spend their time and their money. So please share your investment thesis on Electronic Arts, EA.
Yeah. So I agree conceptually with that idea. It may not be as widespread as kind of traditional gaming in terms of the amount of people, but I do think the time spent will be pretty large because those that will be dedicated to a third world, I think, will be incredibly dedicated. And we've seen that in other areas. Social media is probably a pretty good example, just in like the 2D world. But for Electronic Arts, again, we think gaming is becoming more social in nature, more connected in nature. Cross console is just allowing these networks to now communicate and cross device and cross country. And again, the intersection of kind of people and games and engagement, I think, is pretty powerful. Now, EA, from just a pure valuation standpoint, is incredibly attractive. Financially, the war chest is attractive, but we also like the combination of original content like Apex Legends and Battlefield, along with the licensed content with the FIFA and Madden and some of the others that come with it. Now, recently, they've made a couple acquisitions to focus more on mobile. Historically, they hadn't done a great job on mobile. Part of that, I think, is because of the type of content they had. But part of that, I do believe, is just execution. So over the last couple of years now, they've made a series of acquisitions to try and obviously buy best in breed sports mobile games, and probably going to use some of those best practices for things like Madden and FIFA, and maybe some other games that they come out with. I know they've highlighted golf, and they also have highlighted college football, which I'll be excited about. So again, we love the combination of licensed content and published or original content. That's different from some of the others. We think that licensed content is more of an annuity than it is anything else. And those ecosystems are massive. So we also think there's that risk of obviously the partnership with, let's say, the NFL or soccer would potentially break at some point. But we do think as those networks become bigger and entrench themselves across consoles and such, that's going to make it more difficult to rip those from the original publisher, assuming there's no real setback in terms of the quality of these games. So we like the valuation plus just the execution that they've had here in the last 1.5 years.
Awesome. So one of our favorite companies at the Motley Fool is Fiverr. So what is your investment thesis there?
Yeah, Fiverr is interesting, and we're about to put out something with the Oxford Internet Institute around the digital kind of freelance ecosystem. But in general, like when we step back and we think about the world, we do think, and again, it kind of goes back to COVID as being the accelerant for a lot of things. And I think eventually we were all going to get to many of these places. It's just a matter of time and what was ultimately the catalyst. But basically, we were doing work on Fiverr for quite some time, and look, it's a new space. We're trying to understand kind of freelancing in general and digital freelancing. Fiverr has executed well on a playbook of creating kind of like an Amazon-like experience, but for freelancing, where digital services are bought as a product as opposed to kind of auctioned off and or hourly kind of paid, right? So it's a different experience. It's, you know what you're going to get and how much you're going to pay for it. And that experience, I think, unlocked a lot of or removed a lot of friction, which has created a lot of engagement on that platform. Obviously, COVID accelerated the ability to work from home. And it also, a lot of people lost their jobs and or were working at home and found free time to kind of do something else to make a little bit more money. And Fiverr went from 1.9 million active buyers on that platform to 4 million. We actually thought that they would get to that in 2026. They did that in a year. So that accelerated that viewpoint for us. But again, we think the concept of kind of deconstructing jobs into their core competency is a big deal with Gen Z and a little bit beyond that. And we think, again, people that are design specialists, marketing professionals can focus on that specifically instead of having maybe some of this wasted time in a full-time job function. So we think that the decomposed or deconstructed job is now what we think of freelancing. And now you have a platform like Fiverr to execute that mission and do it successfully. And again, Fiverr's executing across subscriptions, both for the buyer and the seller. We think beyond some of this is potentially again, they announced their subscription for the sellers, which is around kind of building out a call it like a Shopify experience, like a seller dashboard, where you have marketing capabilities and CRM capabilities, analytics. That kind of freelancer was always underserved. And they're doing a lot to build that kind of infrastructure for them. So very interesting company, again, founder led, but someone that has executed wonderfully throughout the years. And we're really excited about the future of Fiverr.
Yeah, so are we. So one of the companies I'm bullish on is Peloton, but y'all have a position in Planet Fitness. So what is your investment thesis there?
Yeah, we actually like them both. We don't own Peloton. But it's incredibly interesting. We do think, and I'll just stick with like Planet and maybe touch like a hint of Peloton from our angle. But for Planet Fitness, we think the network effects that are building here, both when you step back and think about how the world is shaping. I just talked about freelancers in general are some of these individuals that are trying to work from anywhere. You have the Airbnb economy. You have these type of economies that are existing where you're kind of much more flexible in nature. Now, I do think fitness in general is something that is growing in adoption, growing in need. Like it's kind of a must have in this world, some form of fitness, and to do it in a way that is low friction and low cost and has network effects across the country and potentially beyond that, we think is incredibly powerful. So we call them the Walmart of fitness. And again, those two are kind of, I wouldn't say opposites of each other. I mean, they do probably cater to a different audience. And Planet Fitness does a good job, again, of having density across the country where we think, look, I use it personally when I go to Airbnb or something like that. I know there's a Planet Fitness around. So there's this comfort of having a low cost gym membership that's probably everywhere I'm at. Therefore, network effects, in my view, of a world that is becoming much more free and mobile in nature. I think that's a powerful position to be in. In addition, again, it goes back to, unfortunately, COVID, 22% roughly of all gyms went under. And that puts them in a strategically strong position to take some of that market share. So they've listed 4,000, I think a couple days ago. Chris Rondo was on one of the conferences, and he said he thinks 4,000 is now the low end of where they think they can be in the U.S. And again, on the last earnings call, they announced that they were going to Mexico and with a partnership there. So again, I think from a high level view, this kind of more mobile kind of consumer market that we live in and world that we live in now and in the future, I think plays to their strengths. In addition to is the digital aspect, I think I think the fact that now all the users on the platform now have to have the app to check in, I think puts them in a different place. Now they have to execute on this. I don't know if yet they have that prowess from a tech standpoint to really execute in terms of building real robust consumer engagement platform inside of there. But I do think they have the right now everyone's using it, right? So they have time. People don't come to Planet Fitness app necessarily to engage with it for many reasons other than checking in. But I do think it positions them well to potentially expand that opportunity down the road. That's where like a Peloton has done an incredible job of building kind of this at home. Ultimately, I think fitness will be omni-channel, just like retail, just like many of the other things that happen in life. I think we tend to think in extremes, but generally speaking, there's somewhere in between. It's not cloud or on-prem, it's hybrid. It's not online or brick and mortar, it's both. And I think that fitness will be the exact same thing. So.
Yeah, I agree with you. And if we do have, just thinking about it right now, if we do have this sort of hybrid fitness world, working from home part of the time, working in a gym working out in the gym part of the time, that $10 membership is really enticing for the gym membership. Because if you're going to buy a home gym, that's going to cost some money. So putting $10 a month towards Planet Fitness makes a lot of sense in a hybrid world. Just kind of 100%. Thinking right now. What about Omnicell? I don't think I know Omnicell. What does Omnicell do, and what's your investment thesis there?
Yeah, no, I love it. I get the same reaction every time, which is why I love it.
It's good. Yeah.
Yeah, we need more Omnicells in this world. Exactly. And so they're a medication management company. So historically, I mean, look, if you go to your hospital, you'll go on any of the nurse floors. Generally speaking, there'll be medication management cabinets across the floors, and generally it'll be Pyxis, which is owned by Becton Dickinson, or it'll be Omnicell. Omnicell is the leader now. So they have these medication cabinets. That's kind of what they're known for. And 20 years ago, founder-led, Randall Lipps is the founder and CEO. He's executed, his mission-driven. This came from like a personal experience with his family of why he even started doing this and creating cabinets. Those cabinets originally were, for a lack of a better word, dumb in nature. It was a key and you open a thing. And now they're much more biometric and really trying to track what's inside of these cabinets and also who's in these cabinets and where they're going, right? So when we think about the core problem in the world around medication or health in general is around health costs, and a lot of health costs are wasted across medication errors, medication adherence, so people not taking their drugs at the same time and kind of having to relapse and go back into the hospital systems. And again, all these are costs. And I think the summary of all these costs are roughly like $300 to $450 billion a year, where Omnicell is targeting kind of a 99.9% medication errorless rate in terms of across the system. And their goal is to build out the autonomous pharmacy. So they have a system that goes at the center of or the bottom of a hospital system, where if you look it up, I mean, it's their XR2 series. You basically pour 30-something thousand SKUs into a machine, and it automatically sorts and scans all the barcodes. And then essentially across the system, you have the cabinets. So between the centralized pharmacy at the bottom and the decentralized medication cabinets across the system, there's that connection between. That's the gap that they need to fill somehow. And that would put them into a kind of autonomous pharmacy type of positioning. There's actually a whole white paper on the autonomous pharmacy, similar to how people look at Tesla and the EV space. There's a lot there. So they're right now at like level 2, level 3 in terms of trying to build that out. And again, this is a high quality company. They're 50 something percent market share, highly regulated. It's a duopoly between two vendors. And this company is solely focused on medication management, while their competitor is a conglomerate across multiple things. And that was actually more of an acquisition that Becton Dickinson did several years back. And it actually opened up the doors for Omnicell. So that's Omnicell. Again, an incredible story. It's not this hyper growth story, but it's something that grows in the mid-teens to low 20s to low teens at points in time, with continued margin expansion over the last several years. And again, just getting more and more dominant. So we think it's a powerful story that no one knows.
That is very interesting to me. 50% market share, good growth, and expanding margins.
Right.
Yeah, it sounds very. I'm gonna look more into that one. What about Nutanix? What's your investment thesis?
Nutanix. Yeah. So Nutanix was a transformation story. I probably should have some of these attached some sort of which pillar it comes from. But yeah, Nutanix transformation story. It was really around a transformation that was taking place there over the last 2.5 years now. They've gone through a financial transition. They went from term licenses, which were all paid and cash was generated now, to subscription model. Therefore, revenue is recognized over time. That messes up the financials. So you see a pretty steep decline in revenue growth as that transition takes place. They also went from selling roughly like 40 to 50% hardware. They used to sell the server boxes, and that's a commodity. So they actually stopped selling that and started to apply their software to all of the server vendors. So like HPE, Lenovo, Dell, and many others, and became a 100% software company. And that transition, again, knocked off about 40% of their revenue, but it was zero margin revenue. So gross margins went from about 60 to 80 because of it. And then now they're going through the transition of, from an operational standpoint, more so on just efficiency. So they're over the next kind of 12, 18 months, as these subscriptions renew, the ones that they recently just signed about 1.5 years ago. Year 3 is the average term length. As those renew, those renewals come at roughly an 80 to 90% less sales and marketing costs to capture that renewal. Before, you had to go out to market and really try to win these deals again. So again, these will just repeat. And again, it'll look and feel much more like a traditional software company with that 80+% software gross margin. And then we'll start to see those operating margins quickly lever here over the next kind of like 12 to 24 months. And that's the story. It's from a high level though, just to put some context around the opportunity, is the world is becoming more hybrid. So that historically they were more of a on-prem company, on-premise. So they had their stores and servers and compute and networking all on-premise. And that was usually their customer base. But now what they're doing is trying to connect the companies that are essentially using some on-prem, some in the cloud, some using multi-cloud, and really trying to be that central plane to manage all your IT kind of like infrastructure across workloads. And it's really them, it's VMware. Obviously, Amazon is trying to do some of it. Google Anthos is trying to do some of it, but they're trying to play nice with everybody. And look, they have 20,000 plus clients. They're in like 80% of the Fortune 100. And again, they're doing incredibly well from a transitional standpoint. And we think they're just at that inflection point that we were looking for. So
yeah, those transitions can look ugly early on in the process, but then when you're coming out of it, the fundamentals, if you look at like an Adobe or an Intuit or some of these that have already gone through the transition, the fundamentals just greatly improve.
Yeah, that was Nutanix. Yeah, just to clarify the name, it was Nutanix.
Yeah. I was saying other examples are Adobe and Intuit.
Got it.
That have gone through similar SaaS transitions, selling as a subscription. Yeah, Nutanix.
Yeah, sure. No, yeah, those are perfect ones.
Lastly, what is Capri, and what's your investment thesis there?
Yeah, so Capri is Michael Kors, Versace, and Jimmy Choo. So they changed their name maybe like 1.5 years ago, maybe 2 years ago now. Time's flying. But at one point it was just Michael Kors, and again that was like the Lululemon of their day for like their day. And they executed wonderfully there, high cash flow, and they were generating like $900 million in cash flow just from a single brand. Their core competency was actually they sold too much. They were too good at selling that they obviously oversaturated the market with Michael Kors, and that led to kind of too much inventory in the market, which led to price reductions, which led to brand kind of destruction in the near term at that point in time. And again, that was like 4 years ago when that started to happen, or 5 years ago when that started to happen. And with all that cash flow, they decided to acquire Versace, Jimmy Choo. And here inside of this company, you have a growth story in Versace, which is expected to continue to grow its store footprint. So the average kind of luxury retailer has 300 plus locations. When they acquired Versace, it was 180. Again, historically, they've had a good tendency of understanding how to grow these businesses. And that's what they're doing with Versace today. Now, the COVID benefit, again, which is strangely enough, when they had 70, 80% of their fleet basically closed at all times for quite some time, they essentially left or exited COVID in a much healthier position. Not exited COVID because COVID's still around, but they exited kind of the closures at much less inventory, much higher gross margin. So here's a company with gross margins in the mid 60s. So very software-like. We're not that far off. Wow. 20% operating margins. Michael Kors is doing roughly 25, 26% operating margins. Their average unit per kind of item that they sell has increased dramatically, again, because less discounting in the market. Versace is on fire. It's already hitting those 20% operating margins. It was running negative when they acquired it. Wow. So combined, here we have a company where essentially you have Versace as this growth engine, $1 billion today. They think they can get it to $2 billion over time through unit growth and productivity within each store. That doesn't seem unreasonable. Michael Kors is much more of a stability, just continue to sell less, but sell more in terms of margin on each dollar sold. And then the Jimmy Choo part of the business is much smaller. It's really trying to articulate a new vision for Jimmy Choo, but still keep the core identity. Sandra Choi is still the designer there. They actually all still have the original designers. And Donatella Versace's at Versace, Sandra Choi's at Jimmy Choo, and Michael Kors of Michael Kors. And then again, so when you put all this together, here you have a pretty low valued company that is actually seeing pretty strong growth underneath the surface, expanding margins, and by the end of this year, will be pretty close to debt neutral, cash to debt neutral. Which again was part of the hesitation maybe like 2 years ago, because when they made the acquisitions, they took on some debt, and given how heavy their cash flow is, they're able to pay this down pretty relatively quickly. And then we think that's going to unlock more acquisitions into the future and truly become this fashion house. And that's ultimately like the story of Capri.
A bunch of great stock stories here. Sean, thank you so much for coming on the show. And we hope to have you back again soon. This was fantastic. Thank you.